Hello everyone, my name is Sergey. I'm a trader at Trader.com. In this video tutorial, I will try to explain in detail and thoroughly what futures trading is, how it works, and all its details. The first thing you need to know is that the topic is heavy. You may have to watch this video several times to understand everything. Making money online is difficult, but anyone can master it. You just have to try. And I recommend starting practice after theory. Then the concept process will be much easier. So, what is futures? In regular trading, you buy a certain asset and own it. It can be any cryptocurrency, Ether or Bitcoin. The usual trading looks like this. Let's say we bought Bitcoin at a price of $1,000. After a few days, Bitcoin rose by 10% and we sold it and made a profit of $100. This is an example of the simplest trade. It is called spot trading. Futures trading is different. Here we are not buying an asset. Here we buy the so-called contract for the price of cryptocurrency. The contract for cryptocurrencies reflect the value of this cryptocurrency on the spot market. I understand it's difficult, but now everything will be clear and simple to clarify. What is a contract? Yes, in simple words, it is a contract or agreement. In our case, this is an agreement between a person and an exchange. The contract requires mandatory execution. There are the contracts we conclude and we trade them. So, what you should remember: a certain asset operates on the spot market. A contract is in the futures market. What is the benefit for us to trade in the futures market? What does it give? Firstly, the futures market allows us to trade with leverage. Leverage is the borrowed part or the credit part. So, this is the part what we borrow from the exchange. To buy a contract, it is enough for us to have a share of this contract, which allows us to trade with leverage. The leverage size can reach 125x. To be clear, this is 125 times more than if you went to trade with your deposit on the spot market. I must say right away, if you have such an opportunity, it doesn't mean that you need to use it, especially if you are a newbie. I hope this is clear. You see, if you have earned 125 times more in futures when on the spot market, then in case of loss, you will lose 125 times more. The risk is the same. In addition to the fact that in futures trading we have the opportunity to trade with leverage, here you can play not only for an increase. That is, working for an increase is a bet that the asset you have chosen will grow. In futures trading you can also work for a decrease. Here you can bet that the selected asset will go down in price and make a profit from it. Now we have comment the following before moving on. Futures trading is the purchase of a contract that allows you to earn both on growth and on decline, while still providing the opportunity to take leverage. In turn, I will explain leverage and what it means to trade up and down in an understandable manner with examples. Therefore, leverage. Let's use an example. Relatively speaking, we have the first man, let's say this man is a son, and there is a second man, this is dad. My son has $10 and he wants to buy a watch worth $10. He knows that tomorrow the watch will cost $15. He has 10, he buys a watch, tomorrow he sells for 15. At the end of the sale, he earns $5. The son has a debt. Dad has $20. He comes up and says to his father, "Dad, loan me $20. I will buy a watch and it will rise tomorrow. I will sell it and give you more." Dad being dead, he loans $20 to support the idea. In total, the son has his own $10 and 20 from his dad. That is $30. So, 3 times more than you. This means son's leverage is now X3. He went to buy a watch. Now he has X3 leverage, respectively, and the profit will also be X3, 3 times more. With son's $10 and the dad's $20, purchase was made for a total of $30, or 3 watches. 3 watches the next day rise in price and become $45, and the son sells them, getting $45. He returns $20 to dad, and the total profit is $25. We subtract $10 what the son invested and receive a net profit of $15. So, now in this example, the son was trading with a leverage of X3, Respectively, if he borrowed more from his debt, then the leverage and profit will increase accordingly. In this example, his deal was successful. But what if he made a mistake and the watch does not rise in price, but begins to fall? If the son has earned, then everything is clear. He bought it for 30, sold it for 45, gave his debt $20 and ended up with $15 of profit and $10 of his own initial take. Now consider another outcome of events. Watches are starting to get cheaper. The son has $30. He buys 3 watches for $10 and waits. Watches are starting to get cheaper. Every minute the watch drops in value, and he realizes that if the fall continues, soon he will not even have money left to repay the $20 debt that he borrowed from Dad. If you count, you will understand mathematically that there is such a minimum price of watches at which the son will be able to repay the debt by selling them. But if the watch drops below this price, then he will not be able to repay the debt of $20 from the sale of these watches. To calculate this price, you need to divide $20 by 3 and we will get $6.66. So, in this case, the father will never lose his money, which was borrowed from him. The son can lose his money. $6.66. This is the price of the watch at which the son loses his $10 by paying off the debt to his father. Now we introduce a new concept. It is called margin call. Margin call is the moment when the father demands $20 from his son, which he loaned him. He sees how the son made a mistake, how the price of the watch decreases, and understands that if the watch drops below $6.66, the son will not be able to repay the debt. The father intervenes and demands to sell the watch for $6.66, taking his loan of $20. Once again, this moment is called margin call. The son returns $20 and accepts the loss of $10. This is an example of how leverage works. By the way, what I described above in this example is called margin trading. If in this example we replace the watch with a contract, this will be our futures trading. Using this example, I explained what leverage is. Some of you will have questions like, why do we choose futures trading if we can trade margin trading? To answer this question, you need a deep analysis of both trades. Just remember, but 19% of all traders use futures trading, and this is an axiom. It's more convenient, it's better. The vast majority sell it. And you and I will also use futures trading. And so, in the example we had a watch, replaced the watch with contracts, and instead of margin trading, we got futures trading with leverage. Now I'm going to tell you what it means to trade up and down. Remember, trade for an increase, buy. Called long. Trade on decrease, sell. Called short. Buy, long. Sell, short. Now separately, what is and how does the long position work? Forecast for an increase. The price of Bitcoin is $10,000. We predict the growth of Bitcoin. We go to the exchange and put $1,000 on Bitcoin in the long position. With these actions, we sign a contract with the exchange that upon completion of the contract we will buy Bitcoin at the price of $10,000. If you are a SPAC and the price of Bitcoin becomes $15,000, we are satisfied with this and we close the deal. So, the closing time of the transaction depends on us and on the margin call amount. If the forecast comes true, we may not complete the transaction as much as we want. As soon as the amount reaches the margin call, the transaction will be closed automatically. That is, we close the deal at a Bitcoin price of $15,000. The contract obliges us to buy Bitcoin at the price of $10,000 for our $1,000. We are buying 0.1 BTC. 0.1 BTC is now worth more $1,500. Since the calculation on the exchange are all in dollars, we immediately get a change of $1,500. So the profit is $500. Now let's consider the outcome when we make a mistake with the forecast and the price, instead of rising, began to fall. And so, putting $1,000 in the long position at the Bitcoin price of $10,000, we have signed a contract with the exchange Well, we will buy 0.1 BTC upon completion of the contract. The price of Bitcoin began to go down. We waited for a long time, but Bitcoin began to fall and now costs $5,000. There is nothing we can do. The news is bad. We understand that Bitcoin will collapse even more, and in order to lose less, we decided to close the deal. According to the contract, we buy Bitcoin for our $1,000 at the price of $10,000. After closing the deal, we executed the contract and received 0.1 BTC on our account, which was converted into dollars and now costs $500 at the new exchange rate. That's about how contracts work in the long position. More or less simple. It resembles the work of our example with a watch. I have sorted out this position without leverage to make it more or less clear. With leverage, the situation will be as follows. Now we conclude a $1,000 long position with 3x leverage. In this case, we don't have $1,000 in the contract, but $3,000 and $2,000 we borrowed from the exchange. The price of Bitcoin is $15,000. The contract is completed and executed. For $3,000 we bought 0.3 BTC. Now 0.3 BTC is worth $4,500. Of this amount, we return $2,000 to the exchange and we have $2,500 left. Net profit of $1,500. Another situation. In another situation, a margin call starts working for us. That is, the minimum Bitcoin price at which we can still repay the debt to the exchange, but we'll lose our entire deposit. If Bitcoin drops to this price, the contract will automatically end. The exchange will take its $2,000, and we're left with nothing. According to the mathematical calculation, the price of Bitcoin should drop to $6.66,000. If it drops to this price, the deal will automatically close and we'll lose everything. So, an unfavorable moment came. We did not complete the transaction when Bitcoin began to get cheaper, and it collapsed even more. The price for it dropped to $7,000. We don't want to lose everything and don't wait for a margin call, so we closed the deal. Under the contract, we bought 0.3 BTC. The price was $10,000. We took a leverage of $2,000 and our deposit of $1,000. As a result, 0.3 BTC are now at the new rate. The price of our sum is $2,100. Of this amount, we return the loan to the exchange $2,000 and we have only $100 left. If it is not clear, try to watch this part of the video again. Stop at confusing spots, write down, take notes. I try to explain what it means to put a long position on futures. Now we will move to the short position. This is a short game. It may not seem much more complicated here, but if you go deeper and listen carefully, everything becomes simple. And so, after analyzing the market, we believe that Bitcoin will go down in the near future. The price of Bitcoin is now $10,000. We want to make money on this, and for this, we switch to the futures trading exchange and put $1,000 on the short position. Putting $1,000 on Bitcoin in the short position, we sign a contract. The contract is, we sell Bitcoin to the exchange at a cost of $10,000. So, the difference is that in long, we bought from the exchange. In short, we sell to the exchange. It is obliged to buy it from us. The contract is concluded. Now we wait. After a few hours, we see our Bitcoin has fallen to $5,000. We are more than satisfied with this, and we close the deal. Now we are buying Bitcoin at a new price. By buying Bitcoin for $5,000, for our $1,000 we got 0.2 BTC. The exchange is obliged to buy Bitcoin from us at a price of $10,000. It turns out that our 0.2 BTC is now worth $2,000. We had 1,000 and it became 2 times more. As a result, the profit is $1,000. I understand, it is difficult. If you want to understand the theory, I recommended reviewing this part again. Of course, you can start trading signals from our group without much understanding of the theory. Let's move on. In the example above, our prediction came true. But what if our forecast is not correct and instead of Bitcoin getting cheaper, it starts to go up and we have already set short. Let's figure out what will happen in this case. Putting $1,000 on Bitcoin in the short position, we sign a contract with the exchange. We will sell Bitcoin to the exchange at a price of $10,000. We fixed the price. The contract is concluded. We are waiting. After a few hours, we see how the price of Bitcoin has increased and has become $15,000. We are closing the contract because all the news and new forecasts have changed dramatically, and now they say that it will only rise. We had $1,000 and now we're buying it for $15,000. This comes out to about 0.066 BTC. Now the exchange buys this amount of 0.066 BTC from us at a price of $10,000 per Bitcoin. This is $600. So, because of the growth of Bitcoin out of the blue, we lost $400. Now, as in the long position, I explain how trading takes place without leverage. Now I explain using the same examples what would be the profit or loss if we took leverage X3. We conclude a contract with the exchange for the price of Bitcoin and $10,000. We put our $1,000 and more leverage of the exchange at $2,000. In total, we have $3,000. Bitcoin is getting cheaper and becomes $5,000. Now we have $3,000 to buy at this price. So our $1,000 and leverage $2,000. As a result, we were able to buy 0.6 Bitcoins for $3,000. Now the exchange buys 0.6 BTC from us at a price of $10,000. It turns out $6,000. From this amount, the exchange takes its $2,000 loan and we have $4,000 left. Therefore, as a result, the net profit is $3,000. Now the situation is reversed. Again, we conclude a contract with the exchange for the price of Bitcoin and $10,000. We put our $1,000 and more leverage of the exchange at $2,000. Now we have a margin call. I remind you, this is the minimum price of Bitcoin at which we can still repay the debt to the exchange, but we lose everything. The margin call in this example is $15,000. Bitcoin is getting more expensive and becomes $14,000. We are closing the contract because all the news and new forecasts have changed dramatically, and now they say that it will only rise. We don't want to lose everything and close the deal. Now we are buying for $3,000 Bitcoin, which costs $14,000. This comes out to 0.214 Bitcoin. Now we are selling 0.214 Bitcoins to the exchange at a price of $10,000, and it comes out to 2,140. As a result, we return $2,000 to the exchange, leverage, and we have $140 left. And so now we've reviewed and what leverage in long and short positions are. I hope this is clear. If it's difficult for you, try to review this video again more carefully. Let's move on. Before we move on to practice, we need to decide 1-2 more definitions of trading. First, there is a crossover trade. Second, there is an isolated trade. Example, we have allocated $1,000 to take risks on futures. We are ready to risk them to trade to earn. We have already thought it over, revised the old theory, and now we're taking a risk. In order to start trading, the first step is to replenish the futures balance. It is replenished from the spot balance, that is, from a regular wallet. On how to do this, we watch video lessons that relate to practice, but we still have theory. We have replenished the futures balance and in fact are already ready to enter into a deal. After conducting our market analysis, we decided to bet on the increase of Ether. You don't need to put your entire balance on one transaction. We won't use all of the $1,000. We decided to put the amount of $150. That's enough. We put $150 on fact that the Ether is going up. Let's say today it costs $3,000 and we took the leverage X3. For a beginner, the leverage is no more than 5. Instead of the Ether going up, it begins to fall down. So if we trade on an isolated trade, we risk only those $150 that you have in this particular transaction. So we can only lose this $150, no more and no less. I remind you, we have $1,000 in our account. We have allocated $150 for this transaction, and we risk this $150. Our maximum loss on this trade will be $150. But if we have entered the cross, then we're already risking the entire $1,000 that we have on the futures balance. So we transferred $1,000 from the spot wallet to the futures wallet. Open the deal for $150. And if our forecast is wrong, when our $150 is lost, therefore they exceeded the margin call. The Binance climbs into our futures wallet and already takes expenses from this $1,000. One important thing, we transfer from a spot wallet to a futures wallet. And it's only from the futures wallet that Cross Binance will take money when trading. Your spot wallet will not be affected by any trading, whether cross or isolated. There is a futures trading working in USDT in crypto. We'll see everything on the stock exchange. 90% of all traders work only with USDT, so it is important, convenient, and it allows you to get USDT to your wallet and trade absolutely any pairs. You don't need to get attached to crypto assets. There are fewer pairs in futures trading than others. Basically, we trade Ether with BTC. The positions are different. I think this is understandable. Once again, conclusions. Isolated trading risks only money in the transaction. Cross, all the money on the futures balance. Spot, regular balance, doesn't relate to this in any way and works by itself. Recommendations for choosing leverage. I recommend until you gain proper practice to trade without leverage at all, you need to get a hand in trading without a leverage before switching to it. Our task at the trading stage is to learn how to maintain our balance. This is the most important thing, any professional trader will tell you. And as you understand, the higher the leverage, the greater the risk of losing your balance. After we have mastered more or less practice, your leverage will not be more than 3 or 5. Until you gain experience, you do not need to take risks and take big leverage, as it would not be tempting. Remember, the greater the leverage, the higher the margin call, the minimum amount of cryptocurrency at which we lose our deposit. But we can still give money to the exchange. Let's remember the rule again. Before earning, you need to learn how to save money. Remember as an axiom. Now we're switching to Binance. This is where the training will continue. Before starting trading, I would like to show you the place where it is located and some things we need to be fulfilled before trading. And so I switched to Binance. I logged into my personal account. Now, where do we have futures? We go into derivatives, and the first thing we have is finance futures. These are small instructions. I recommend going in, reading, watching, learning. Next, this, responsible trading. Here Binance warns you that futures are extremely risky trading. Next, we see two options, USDT M futures and Coin M futures. USDM is an indefinite or quarterly contract in the calculation of a stake coin. Dollars and Coin M futures are the same contracts in the calculation of cryptocurrencies. So here we are trading crypto. 90% of traders trade in USDM in the first option. That's where the trading will continue. It's more convenient for everyone to make calculation in stable coins. Before we go to learn the trading interface in the next video, I will say a couple more things. If someone is watching us from European countries, then pay attention to the fact that Binance Futures trading is not available for you. You will need to switch to another exchange. There should be no problems with it, since all interfaces are of the same type. Therefore, if futures are restricted for you, use another exchange. This also applies to the United States or any other countries where this trade is banned. All those who have Binance Futures available, when you open this window for the first time, the Binance will most likely require you to take a test. It is different every time and changes every month. It is necessary to go through the process and solve it responsibly. There, again, they warn about the risks. If you have any problems with this, I recommend just writing to our work chat, where our colleagues will help you to solve it. That's all with the theory. If it is not clear, I recommend watching the video again. I recommend moving on to practice. Subscribe to our informational channel, join the chat. We are always looking forward to new partners and participants. I wish you all the best and success in your studies.